Have you ever woken up at 3 in the morning with your heart racing, wondering if you should sell everything before it's too late? I'm going to tell you something that might make you even more uncomfortable. This feeling, this urgency to do something now, is exactly what destroys more assets than the crash itself. I spent 47 years navigating financial markets, managed $160 billion through 4 major global crises, and the most brutal lesson I learned was this: panic kills more fortunes than any market collapse. In 1987, I saw investors lose 38% of their equity, not because the market dropped 22% in one day, but because they sold everything in the fund and never came back. In 2008, history repeated itself in an even more devastating way. The S&P 500 fell 57% from peak to trough, but the average individual investor loss was 73%. Why? Because they sold in March 2009, exactly when they should have been buying. Now we are in 2025, and I am seeing the same signs of extreme strain in the global financial system that preceded the last collapses. The difference is that this time the debt bomb is 40% larger, the leverage in the system is 62% higher, and the amount of money printed since 2020 has created price distortions that I have never seen in my 5-decade career. And if you're not already subscribed to this channel, subscribe now, because what I'm going to share over the next few weeks could be the difference between preserving and losing your heritage in the coming years. And I'm not exaggerating when I say that we are in the most critical moment since the Great Depression of the 1930s. Let me show you exactly what I'm seeing, and why the biggest risk is not the crash itself, but your reaction to it. There are 7 specific signs that always appear before major market crashes, and all 7 are present now for the first time since 2007. The first is what I call late euphoria, that moment when even your uncle who has never invested is giving you tips on stocks and cryptocurrencies. In January 2007, 89% of individual investors were optimistic, according to the American Association of Individual Investors survey. Do you know when that number hit bottom? March 2099, with only 18% optimistic, exactly when the market began the biggest 11-year rally in history. The second signal is implied volatility compression. When the VIX, the market's fear index, stays below 12 for prolonged periods, like it did in 2006 and 2007, it means investors are pricing in zero chance of trouble ahead. It's like driving at 200 kilometers per hour thinking the road ahead is perfectly smooth, when in fact you are entering a sharp bend in the dark. The third sign is institutional flows. When pension funds and endowments increase risk allocation above 75% of the portfolio, historically, this marks market tops. Why? Because these institutions are the last to join the party, and when they arrive, there is no one left to buy. In 2007, average allocation in pension fund stocks reached 78%. In 2024, we exceeded 80%. The fourth sign is what I call yield hunger, when investors accept ridiculous returns for enormous risks. In 2006, AA-rated subprime paper paid just 80 basis points above treasuries. Everyone knew it was rubbish, but the hunger for returns made sophisticated investors pretend they didn't know. Today, I see the same pattern in corporate bonds of companies that should be in judicial recovery, but pay only 200 basis points above treasuries. The fifth sign is systemic leverage. I'm not just talking about margin on brokerage accounts, which, by the way, is at record levels of $793 billion. I'm talking about leverage hidden in derivatives, in structured products, in carry trades that no one can measure properly until they explode. The Bank for International Settlements estimates that there are $680 trillion in notional derivatives outstanding globally. To give you an idea, this is 8 times the world GDP. It's a chain of dominoes where each piece is connected to 20 other pieces. The sixth signal is the market behavior itself. When you see stocks rising 3, 4, 5% on days with no news at all, when you see small caps having 20% rallies in 2 weeks, when you see correlations between assets breaking down because everything rises together regardless of fundamentals, you are seeing the last stages of a bull market before the violent reversal. And the seventh sign, perhaps the most important, is what happens with liquidity. In 1987, Market liquidity completely dried up within 15 minutes on Black Monday. In 2008, entire credit markets froze for weeks. The illusion is that you always manage to get out before others. The reality is that when everyone tries to leave at the same time, the doors become very, very narrow. And I want to know from you, where are you watching this video from? Leave a comment telling me your city and country, because these patterns are global, and I want to understand who is paying attention in different parts of the world. As these signals intensify and the market continues to rise, as if nothing can go wrong. Now let me tell you two stories that forever changed how I think about market crashes and investor behavior under extreme pressure. The first story is about a hedge fund manager named Richard, who I met in 2006. Richard was brilliant, graduated from MIT, PhD in applied mathematics, had consistent returns of 23% per year for 8 consecutive years. His fund had $3.2 billion under management, and he operated a statistical arbitrage strategy that worked perfectly until it didn't. In June 2077, Richard began to see his models giving warning signs. Correlations were breaking down, volatility was starting to rise abnormally, credit spreads were expanding, but he had a problem. He was having his best year yet, with returns of 28% in the first 5 months. Its investors were euphoric. They wanted to put in more money. And here's the deadly psychological trap. When you're winning big, every sign of risk feels like a temporary noise that will pass. Richard decided to not just hold positions, but increase leverage from 4 to 6 times. Because, in his words, the spreads were so wide that there was easy money on the table. In August 2007, when the credit market froze, Richard lost 42% in 3 weeks. Investors panicked and demanded redemptions of 83% of the capital. He was forced to liquidate positions at the worst possible prices, which accelerated the decline. By September, the fund had lost 79% of its value. In October, Richard closed the fund and returned what was left to investors. $3.2 billion became $670 million. But the story doesn't end there. This is the part that really stuck with me. Richard had 92% of his personal wealth, approximately $48 million, invested in his own fund. He lost $42,800,000 in a matter of weeks. When I talked to him a year later, Richard told me something I've never forgotten. The money was painful to lose, but what really destroyed it was the paralysis. He saw the signs in June, knew he should reduce risk, but was unable to act because his ego, his trust in the models, and the pressure from investors who wanted more returns created a psychological prison. He told me that he woke up at 3 in the morning knowing he had to do something, but during the day he rationalized that he was being cowardly or too pessimistic. When he finally decided to act in August, it was too late. The lesson is not that Richard was incompetent or stupid. The lesson is that extremely intelligent and sophisticated people become paralyzed or make terrible decisions during crashes because the human brain did not evolve to deal with extreme wealth volatility. The second story is about what happened at Bridgewater in September and October of 2008. At that time, we managed about $85 billion and had spent 2 years preparing for a severe credit crisis. Our debt cycle model had been signaling since 2006 that we were in the late phase of expansion and that a painful contraction was coming. In 2007, we began to build protection through positions in long-term treasuries, gold, and shorts in financial institutions. When Lehman failed on September 15, 2008, the chaos was instantaneous and visceral. In the first 3 days after the crash, we saw sophisticated institutional clients, giant pension funds, university endowments that had been around for 150 years, all going into full panic mode. They didn't call asking for advice on what to do. They called demanding immediate liquidity. I received a call from a CIO of a $23 billion pension fund at 7 in the morning on September 17th. He said, and I will remember these words forever, "Ray, I need $3 billion in cash by Friday, or I'm going broke. I don't want to hear analysis." And I don't want to hear about long-term. I need money now. This man had 32 years of experience, had navigated the crisis of 1987, and had a PhD in economics. But at that moment, he was not a rational professional. He was a scared animal trying to survive. We liquidated positions for him, but tried to convince him to keep at least part of the protection. He refused. He wanted pure cash. That fund ended up losing 41% that year because it sold everything, including the protection that was working, and was left in cash exactly when they should have been buying liquidation assets. Meanwhile, at Bridgewater, our all-weather strategy that had built-in adequate protection gained 12% in that apocalyptic year. Not because we were smarter, but because we had a process that forced us to maintain risk balance through all market conditions. We had a rule: never make allocation decisions based on emotion or short-term timing. Rebalance mechanically, maintain true diversification, and never, ever panic. But here's the brutally honest part that bothers me to this day. Even though we had the process right, even though we saw our funds performing well as the world fell apart, I still felt panic. I would wake up at 4 in the morning, sweating, checking Bloomberg, wondering if the global financial system was really going to collapse for good. The difference wasn't that I didn't feel scared. The difference was that I had a system that prevented me from acting based on fear. These two stories illustrate the most important truth about surviving crashes. Your biggest enemy isn't the market crashing, it's not the financial system crashing, it's not the algorithms or hedge funds or any outside force. Your biggest enemy is yourself, or more specifically, the part of your brain that evolved to evade predators and that interprets market volatility as an immediate physical threat. When markets drop 20, 30, 40%, your limbic system takes over and you go into fight or flight mode. In this state, you are incapable of long-term rational thought. Your brain is screaming, "Do something now. Get out of this situation. Protect yourself." And here's the cruel paradox. Doing something, which is the natural impulse, is almost always the wrong choice. Studies show that investors who move their portfolios more during crashes have dramatically worse returns than investors who do nothing. A Vanguard study analyzed investor behavior during 2008 and found that investors who did not touch their portfolios experienced an average loss of 39% that year, but recovered everything by 2001. Investors who actively sold and bought during the crisis lost an average of 58% and took up to 2016 to recover. The difference between losing 39% and losing 58% is not small. On a $500,000 portfolio, it's the difference between losing $195,000 and losing $290,000. That's $95,000 burned not by the crash, but by the reaction to the crash. So if panic is the enemy and acting impulsively destroys returns, what's the answer? How do you survive the worst crash of your life without panicking? The answer lies in building what I call a crisis survival system before the crisis arrives. Let me explain the framework we use at Bridgewater and which any investor can adapt. The framework has 5 fundamental pillars, and each pillar has a specific purpose to protect you from yourself when chaos arrives. The first pillar of the survival system is what I call true risk balancing. And no, this is not the traditional 60% stocks and 40% bonds model that your financial advisor probably recommends. This model is an intellectual fraud that leaves you exposed to risks you don't understand. Why? Because 60-40 means that 95% of your risk comes from stocks. When stocks fall 50% in a crisis, your 60-40% portfolio falls 33%, even with the bond portion rising. This is not diversification, it is masked concentration. True risk balancing means that you allocate your portfolio so that each asset class contributes equally to total risk, not total capital. In practice, this means having larger positions in lower volatility assets, like treasuries, and smaller positions in high volatility assets, like emerging market stocks. When we built the all-weather strategy in the 80s, After I had lost everything in 1982 by being overly positioned in one direction, I realized that the only way to survive any market environment and to have active protection for 4 possible economic scenarios. Scenario 1. Economic growth above expectations. In this environment, stocks and commodities perform well. Scenario 2. Growth below expectations. In this environment, treasuries and long-duration bonds rise. Scenario 3. Inflation above expectations. In this environment, commodities, tips, and some real assets protect you. Scenario 4. Inflation below expectations or deflation. In this environment, treasuries and long-term nominal bonds explode upwards. The magic is not predicting which scenario will happen. The magic is to have protection for all scenarios simultaneously, so that, regardless of what happens, you have assets that will perform well enough to compensate for assets that will perform poorly. In 2008, the scenario was growth and inflation collapsing at the same time, which is deflation. Stocks in the all-weather portfolio fell, but holdings in long-term treasuries rose so much that the total portfolio gained 12% as global markets melted. In 2021, when inflation exploded, positions in commodities and tips rose so much that they offset the decline in treasuries. The logic is simple but powerful. You can't predict the future, but you can prepare for multiple possible futures. And when crisis hits and your brain panics, you don't have to make difficult decisions about what to do because your portfolio is already structured to survive. The second pillar is what I call mechanical rebalancing rules. Here's a brutal truth about human behavior. You will want to sell when you should buy, and you will want to buy when you should sell. It's inevitable. So the only solution is to completely remove your ability to make these decisions in the heat of the moment. At Bridgewater, we have absolute rebalancing rules. If stocks fall and now represent 20% less of our target risk, we rebalance back by buying more stocks. We don't discuss whether it's the right time. We don't analyze whether it will fall further. We simply execute the rule. In March of 2009, when the S&P 500 reached 666 points and everyone was sure it was going to fall to 500, our rules forced us to buy. It was psychologically torturous. Every instinct screamed to wait longer. But rules have no instinct, they have no fear, and they were right. For an individual investor, this means deciding now, while you are calm, exactly what you are going to do in different scenarios. If the market drops 15%, I will rebalance by buying enough to get back to the original allocations. If it drops 30%, I'll do the same. If it drops 50%, I'll do the same. You write down these rules, sign them below, and commit to following them no matter how you feel at the moment. The rule removes emotion from the equation. And here's the crucial point. Mechanical rebalancing is not about perfect market timing. It's about ensuring that you are always buying assets that have become relatively cheaper and selling assets that have become relatively more expensive. It's impossible to do this based on emotion, because emotion leads you to do the opposite. The third pillar is strategic liquidity, and this is completely different from having money sitting in cash waiting for the crash. Strategic liquidity means structuring your portfolio so that you always have assets that you can sell quickly without devastating losses, even during a severe liquidity crisis. In 2008, I saw sophisticated investors forced to sell illiquid assets for 10-20 cents on the dollar, because they needed to meet margin calls or redemption obligations and had nothing liquid to sell. They weren't selling because they believed those assets had no value. They were selling because they had no choice. Imagine having a house worth $1 million but needing $100,000 in 3 days and not being able to sell the house in time. You end up selling for $700,000 in a forced sale, not because the house is worth less, but because you don't have time. Strategic liquidity means having at least 20 to 30% of your portfolio in assets that we know will definitely have buyers even on the worst day of the crisis. U.S. Treasuries, physical gold, large-cap index funds, not because they are the best investments, but because they are the assets that you can sell in 2 hours if you need to. This liquidity gives you power during crises, It gives you the power to not be forced to sell anything at the wrong time. It gives you the power to buy liquidation assets when others are being forced to sell. In March 2020, when markets fell 34% in 3 weeks, our liquidity allowed us to buy credit spreads that were at 800 basis points and resell them 6 months later at 250 basis points. 15% gain in 6 months risk-free, simply because we had cash available when no one else did. The fourth pillar is active protection through put options or tail risk strategies. Here, I need to be honest about something that many investors hate to hear. Protection costs money, and most of the time, it will seem like a waste. It's like car insurance. You pay every year, and most years you don't use it, and it feels like you're throwing money away. Until the day you suffer a serious accident, and that insurance is worth 100 times what you paid for it. Buying long-term puts or collar structures means you are paying a premium, typically 1 to 2% per year of the portfolio value, to limit your maximum loss in a crash. If your portfolio is worth $1 million and you spend $15,000 a year on put protection, you are ensuring that your maximum loss in a 50% crash is limited to perhaps 20 or 25%. 19 years out of every 20, you're going to look at that $15,000 and think you wasted money. But in year 20, when the crash happens, that protection is worth $300,000 to $400,000. The math is clear. If you pay 1% a year for 20 years, you spend 20% of the total capital. But in a 50% crash without protection, you lose $500,000. With protection, you lose $250,000 plus the 20% you paid in premiums over the years, so total $450,000. Still, you're $150,000 better off. But more important than mathematics is psychology. When you have protection and the market starts to crash, you don't panic in the same way. You know your losses are limited. This mental tranquility allows you to make the right moves at the right time instead of freezing or selling everything. At Bridgewater, we use sophisticated protection structures that I will not detail here, but for an individual investor, the simplest way is to buy SPY or broad index puts with strikes 15 to 20% below the current market and duration of 6 to 12 months. It will cost between 1.5% and 3% per year, depending on how long the market went without correction. It's expensive, but it's the price of sleeping well at night. The fifth pillar, and perhaps the most important, is what I call emotional isolation through automation and stimulus elimination. Here's something I discovered in the most painful way possible. The more you look at your portfolio during a crisis, the worse decisions you make. There is a famous study that showed that investors who checked their portfolio daily during 2008 had 42% worse returns than investors who checked their portfolio monthly. Why? Because every time you look and see red, your brain reinforces panic. You start to rationalize bad decisions. You start to think that this time is different, that the world is really ending, that you need to do something. The solution is radical automation. Set up your rebalancing rules with your broker or advisor to run automatically. Configure not to receive emails about daily performance. Uninstall the brokerage app from your cell phone. Seriously, delete it from your phone. During 2008, I made a conscious decision to stop looking at the intraday performance of our funds. I looked at closing once a day, wrote down the numbers, and closed Bloomberg. This saved me from hundreds of bad micro-decisions I would have made, seeing hourly volatility. For individual investors, my recommendation is more extreme. During a severe crash, look at your portfolio no more than once a week. Set up automatic alerts to execute your rebalancing plan. But don't stare. Every time you look, you are forcing yourself to emotionally process something that your brain was not designed to process, and you will make bad decisions. Also eliminate external stimuli that increase panic. During crashes, financial media profits from your fear. Each title is designed to make you click through horror. 10 reasons why the market will drop another 50%. It is the end of capitalism as we know it. Analyst predicts depression worse than 1930. All this content doesn't inform you. It terrifies you. And when you're scared, You make bad decisions. So during crashes, zero CNBC, zero Bloomberg TV, zero Twitter from finfluencers, zero podcast from traders. You follow your plan that you created when you were calm and completely ignore outside noise. This is not sticking your head in the sand. It's recognizing that you are human with predictable cognitive biases and removing the triggers that activate those biases. Now, I know exactly what's going through your head because I've seen this resistance 1,000 times in 4 decades. You're thinking, Ray, this all sounds good in theory, but I need to be aware of what is happening. I need to be able to react if things get really bad. What if this time is different? What if the system actually collapses? Let me be brutally honest about these objections. The first objection is the illusion of control. You think you need to be alert and able to react quickly, but all the evidence shows that reacting quickly during crashes leads to horrible decisions. You are not being prudent, you are being reactive. And being reactive in times of high volatility is statistically the most reliable way to destroy long-term returns. Show me an investor who actively trades during crashes, and I'll show you someone who underperforms the market by a massive margin. The second objection is, this time is different. I heard this in 1987 when program trading algorithms were the new threat that was going to crash markets forever. I heard in 2000 when the internet changed all the valuation rules. I heard in 2088 when credit derivatives created systemic risk that was impossible to quantify. I heard it in 2020 when a global pandemic was going to destroy the economy permanently. Every time is different in the details, but it is never different in the fundamental principles. Productive assets continue to generate long-term value. Economies adapt and recover. Markets price too much panic on the way down and too much optimism on the way up. These patterns have been repeating themselves for the 300 years since stock markets have existed. The third objection is, what if the system actually collapses this time? What if the dollar loses reserve currency status? What if the government is unable to rescue the financial system? What if we really go into depression? These are legitimate concerns, but let's think clearly. If the global financial system collapses permanently and irreversibly, your stocks, your bonds, your money in the bank, everything will go to zero. In this true apocalyptic scenario, it doesn't matter if you sold everything and stayed in cash because cash is also worthless. Your only real protection would be physical assets like land, commodities, gold, and survival skills. But here's the reality. In 400 years of modern history, we have never had total permanent collapse of the financial system. We have had severe crises, depressions, world wars, hyperinflation, but financial systems always rebuild themselves because they are fundamental for the functioning of societies. So, building your investment plan based on the permanent total collapse scenario is building your plan for the lowest probability event, while ignoring high probability events. It's like refusing health insurance because you're worried about a meteor strike that kills all of humanity. It makes more sense to prepare for the high probability scenario, that is, severe crisis followed by gradual recovery. And the best plan for this scenario is exactly the framework I described. True diversification, mechanical rebalancing, strategic liquidity, protection via options, and emotional isolation. These 5 pillars give you the greatest chance of not just surviving, but thriving during and after a crash. But let me give you a 6th element that I rarely talk about, but that may be the most valuable of all. This element is what I call identity preparation. The reason why crashes destroy so many people is not just financial, it is psychological and even existential. Many investors, especially those who have been successful in the market for years, build part of their identity around being good investors, understanding markets, making the right choices. When a devastating crash happens and they see their portfolio drop 30, 40, 50%, it's not just money they're losing. It is concrete proof that they are not as good as they thought, that they do not understand as much as they thought, that the choices were not as intelligent as they seemed. This creates an identity crisis that amplifies financial panic. I've seen this happen to brilliant managers who went into deep depression after crashes not because they lost everything, but because they lost the narrative of themselves as invincible experts. Identity preparation means accepting, before the crisis hits, that you will lose money, what markets will fall, that your portfolio will stay red for months or years, that this is not a reflection of your intelligence or competence, which is a normal and inevitable part of market cycles that have existed for centuries and will continue to exist. When you truly internalize this, when your identity is not tied to short-term performance, you gain enormous psychological freedom. You might see your portfolio drop 40% and think, okay, it's a severe but expected correction. I'm not losing money because I made dumb choices. I'm seeing normal risk-asset volatility. My plan remains intact. This change in mindset seems subtle, but it is revolutionary. It's the difference between going into an existential panic and simply executing a prepared plan. A practical exercise I recommend: sit now, while markets are relatively calm, and visualize your portfolio dropping 50%. Really imagine seeing that number. If you have $500,000, imagine seeing $250,000. If you have $2 million, imagine seeing $1 million. Feel the emotions that arise: fear, panic, anger, shame. Allow yourself to feel all of this now, in a controlled environment. So ask yourself, okay, this happened. My portfolio dropped 50%, but I'm still alive. My family is fine. I have a job or skills. Life goes on. What do I do now? The answer is, I follow my mechanical rebalancing plan, maintain diversification, and wait for the recovery that has always come historically. Doing this mental exercise in anticipation builds emotional resilience. When the real crash comes, it won't be your first time processing these emotions. You've already tried it. You already know that you can survive psychologically, and this certainty gives you the courage to execute your plan instead of freezing or panicking. I also want to talk about something that few people mention: the opportunity cost of avoiding crashes versus the cost of being in the market during crashes. There is a popular narrative that smart investors can get out before crashes and come back before recoveries, capturing upside without downside. This is fantasy. The math of market timing shows that you need to be right twice: right when you leave and right when you come back. And the error window is microscopic. A J.P. Morgan study analyzed returns from 1993 to 2013, 20 full years. If you stayed invested the entire period in the S&P 500, your annualized return was 9.2%. If you missed the 10 best trading days, which is less than 0.5% of the total trading days, your return drops to 5.4%. If you missed the 20 best days, it drops to 3.2%. And here is the data that kills the idea of market timing. Of the 10 best days of market performance in these 20 years, 7 occurred within 14 days of the 10 worst days. In other words, the biggest rallies happen during or immediately after the most severe crashes. If you sold to avoid the worst days, you probably also missed the best days. And that is the death trap of market timing. You need to guess not only when to leave, but when to return. And no one, absolutely no one, can do this consistently. At Bridgewater, we analyze the histories of thousands of managers and traders over decades. Consistent market timing success rate over multiple cycles? Statistically indistinguishable from zero. The few people who seem to succeed in one cycle fail in the next ones. So the math is clear. Trying to avoid crashes through timing has a greater opportunity cost than accepting volatility and remaining invested according to a well-diversified plan. It's counterintuitive, but true. You become richer by accepting crashes than by trying to avoid them. Now, let's talk about practical preparation for the next crash. Because, let me be blunt, based on all the signals I've described, I assign a 60 to 70% probability of a correction of 30% or more over the next 18 to 36 months. I'm not saying it's going to happen tomorrow. I don't know when exactly, but debt patterns, leverage, valuations, and market behavior are so similar to previous pre-crisis periods that it would be irresponsible not to prepare. So what specifically do you do for the next 3 months? First, audit your current portfolio and calculate your true risk. Don't just look at allocation by dollars. Calculate how much of your total risk comes from each asset class. If you have 60% in stocks, 20% in bonds, 10% in REITs, and 10% in cash, your risk is not 60-40. It's probably 90-10, because stocks and REITs are highly correlated in crashes, and short-term bonds protect almost nothing. Use historical volatility as a proxy for risk. Stocks have vols of 18 to 20%, REITs of 22 to 25, long-term bonds of 10 to 12, short-term bonds of 3 to 5. Multiply your allocation by volatility to see each asset's risk contribution. Second, increase bond duration. If you have bonds, make sure that at least 60% of the fixed income allocation is in treasuries lasting 10 years or more.